Hello, we're going to go over our homework number 3 in my accounting lab for financial reporting 2. And this question deals with our FIFO and LIFO dollar value concept. And let's just review that real quick from our PowerPoint. Essentially, dollar value pulls inventory items and uses a dollar as the common measure of inventory. It's too complex to convert FIFO and LIFO based on quantities, which is basically probably a more accurate view of it. But because it's not practical to go through all the quantities in a perpetual inventory, dollar value LIFO was created to deal with the total dollar amounts of inventory, so it creates a pool of items and uses a dollar as the common measure. The advantages are the firms account for dollars, not units. It avoids problems when there are changes in product mix and can minimize the likelihood of liquidation. The solution to a dollar value LIFO is to determine the ending inventory stated in terms of base year prices. The base year prices are basically your ending inventory balances. And you assign a cumulative price index to each year to come up with an ending inventory at base year price. Step 2 is determine the increase or decrease in the quantity at base year prices. So you're basically taking your ending inventory year end and you're dividing it by this price index, and then you're basically taking the change in the base year prices for each year and determining if it's an increase or decrease. Determine the increase or decrease in quantity at current prices. 4. Add all the layers together to get the dollar value LIFO ending inventory. 5. Calculate the LIFO reserve. And 6. Record the journal entry to make the LIFO adjustment. Your journal entry is going to be a debit or to cost of goods sold or credit to cost of goods sold, depending on an increase or decrease in the reserve. So basically, we're going to go right to the problem. And it's problem 13 of 16. Bojangles Incorporated adopted the dollar value LIFO method last year. Last year's ending inventory was $53,700 last year, with a price index of 1. The ending inventory for the current year at year-end FIFO cost is $99,000. And the price index is 1.1. Based on this information, compute Bojangles' ending inventory for the current year on a dollar value LIFO basis. So last year, our ending inventory price was $53,700, and the current year end at FIFO is $99,000. We're told that the cumulative index is 1, and for the current year, 1.1. You divide 53,000 by 1, and you get 53,700 ending inventory at base year prices. The current year of 99,000 gets divided by 1.1 to get an ending inventory at base year prices of 90,000. You then take the current year ending inventory at base year price for 90,000 and drop it in as your current year, and you subtract the ending inventory at base year prices from last year to get an increase of $36,300. Following that step, you take the increment of $36,300 and you multiply it by the latest current year of 1.1, which equals 39,930 is the increase in quantity at current year prices. So to determine your ending inventory under dollar value, you simply take last year's layer of 53,700. You add 39,930 from your increase in quantity at current year prices to get an ending inventory under dollar value LIFO of $93,630. And essentially, this is your work solution. So that's basically how to handle and solve problem 13 for homework number 3. Problem 14 on homework number 3 is a write-down method using both the direct method, write-down journal entries, and the indirect method. And so prepare the journal entry to record the write-down to market for stain-resistant model under the direct and indirect methods. Assume American Clothing Company has 4,500 units of stain-resistant model in stock. The write-down per unit of stain-resistant raincoats is $21. In this case, we're going to have to write down each unit of this inventory item by $21. So simply take the $21 and times it by the 4,500 units. That'll give you a $94,500 write-down. But the accounting journal entries for the direct method and indirect method are slightly different. Under the direct method, simply debit cost of goods sold and credit inventory. Simple enough. On the indirect method, we create an allowance to reduce inventory to market, and we debit loss on inventory write-down. This loss on inventory write-down is your expense in the cost of goods section of your income statement. The allowance to reduce inventory essentially is netted against your inventory on your balance sheet to get a net carrying value or net realizable value on your inventory. So you end up basically with the same results as a cost of goods sold and inventory method. Problem 15 basically is a retail cost to retail ratio problem. And we basically are going to do the retail method here. So when you click on your icon, you're going to get your information. Your beginning inventory cost is $60,590. Sold at retail of $83,000. Purchased $273,110. Your retail is $371,000. Net markups. We had markups of $27,000 retail, but we canceled $11,000. So the net markup is $16,000. Simply add them up, and your cost is 71% of retail. So 71% of your retail sale is cost. Then you subtract your net markdown. So you had markdowns of $13,000, but you canceled $1,500. You wrote down the retail to get to $333,700 and $458,500. You're basically given that sales are at retail of 450,000. So your ending inventory on a retail side is 8,500. Simply take 71% of the 8,500 and your ending inventory is $6,035. Your cost of goods available for sale are $33,700. Essentially, here's your solution. Here's how you get your net markups and your net markdowns. Simply get the schedule right, and you'll get the answer right. So that concludes some of the more complex problems in homework number 3 for this week. Thank you.